Hey, best ever listeners. Welcome to the best ever CRE show. This is Beyond Multifamily. I'm Amanda Cruz, joined with Ash Patel. What's up,
Hey,
Ash?
Amanda, how are you doing?
I'm great. How are you doing?
I'm doing well. So today's guest is Brad Johnson from Irvine, California. He's the co-founder and CIO of Vintage Capital. They invest in private markets on behalf of accredited investors, portfolio of over $200 million. And bulk of that is in mobile home parks, right up your alley.
Heck yeah, I like that. What questions do you have for him? What do you want to know, Ash?
I'm gonna end up sitting quietly in the corner and you're gonna dominate the conversation. I'll try to break things apart as I see them, but so it sounds like he's a combination of capital raising and deploying into mobile home parks. You know, the biggest question I have is why only mobile home parks? Why not diversify?
I bet he is diversified, so I'd like to understand that. I'd like to understand how they're able to do due diligence on an asset class that they may not be part of and just kind of understand that process. But I mean, you and I are familiar enough with due diligence across lots of different asset classes. So I'd love to understand what other people are doing and how they're feeling comfortable.
Yeah, but DD in your world is completely different. The latest thing that we ran into is that whole septic thing, whatever the hell, the pond, right?
Yeah,
Um,
that's right. You
and,
don't want any wastewater treatment plants.
yeah, like that never would have come up on our radar because we never deal with that kind of stuff, right? But speaking of mobile home parks, I saw there's a bill in Washington for rent control, and they're also including mobile home parks.
That's right. This is not the first time, right? There are other states with rent control out there. This one will probably pass. Who knows, right? It's in Washington state, so it'll probably pass. I mean, okay, first and foremost, that's why we invest in states that aren't going to put up rent control. Okay, so I'm not investing in Washington state.
Red states.
Yeah, I like having landlord friendly states where if we need to get tenants out, we can. We don't want tenants to get out. So that's like a funny thing, right? As landlords, we want tenants to stay. But sometimes there are bad actors. We have drug dealers that somehow get through screening. We want them out. And we need to be able to raise rents to market rents in order to maintain properties, especially those with septic systems and roads and stuff like that. So, yeah, I'm not investing in Washington state. How about you?
Well, no, we don't invest in blue states. We try not to invest in blue states, but you know who's big out there? I think our buddy from Three Pillars Investments.
Daniel.
Yeah, good friend of the show. But I thought he was big out there, right?
He is, at least I don't know about in Washington. He has stuff he's building in Montana. And I know he's had, struggles with that whole process and trying to get homes built and sold out there. I don't know if it's related to rent increases. I doubt it in Montana, but yeah, it'd be good to if it goes through, we should find somebody who's impacted and bring them on.
Yeah, good idea.
But also keep in mind that lot rents are way lower than standard rents. So if you have lot rent, really the big value add is pushing it to market out of the gate. Once you're at market, you really don't have that high of rent increases. So it's going to impact the value add space way more than it would a stabilized asset.
So let's dive into that with Brad when he joins because I want to get his take on that as well.
Perfect.
Hey, I got to tell you something crazy. The Ohio, whatever, somebody in Ohio is getting a constitutional amendment on the ballot to get rid of property taxes.
There you
To
go.
completely
Okay.
abolish property
Interesting.
taxes.
Hey,
And
follow up on that.
the crazy thing is all they need is signatures to make it onto the ballot. And then it goes to the people for a vote. How the hell is that not going to pass?
Yeah, I don't know, Ash. I have a hard time believing that they would actually be able to get it on the ballot and to get passed. And then you can just put in different legislation. Like that's a revenue stream. There's no way that's going to be, we're just going to get rid of property
I
taxes.
get it. They'll have to substitute that with income taxes, sales
Exactly.
taxes, something, right?
They're not getting rid of that income stream. They need it. So
And then on some of the forums, I heard people pushing back against that. And of course, they're like, well, For homeowners, it's great, but commercial property owners should still pay property taxes, which may happen.
And
which,
the average voter is absolutely going to be down with that.
Yes. So that'll be interesting. I'm surprised it's not getting more press because, people post COVID have complained about property taxes going through the roof. And now here we have a constitutional amendment in Ohio. Be interesting to see how this pans out.
For sure.
What else is happening in your world?
Dude, we went under contract on a mobile home park today that I'm not that excited about, but it's really, really, really cheap. So we'll at least go through the steps and see if we're going to buy it.
Mobile home parks are still trading at pretty high prices, right?
Not this one.
No. Okay. Did you just offer low or is it just a shithole?
Both. It's a combo. It needs a ton of work. The guy's a conspiracy theorist. He's off the grid. Like everyone who's calling him is not. I mean, we've been working him for like a couple of years. It's close to another park we own. So we just, it's not even that big either. There's like 18 spaces, but it's just really cheap. So we'll go through the steps and see if we want to buy it. Jonathan really wants to buy it.
It sounds like you're not going to be that upset if you don't buy it.
Absolutely not.
Okay.
No, it's going to be a lot of work is what it's going to be. But, there's upside. What about you?
Oh, I got to tell you. So yesterday we were on the phone with a broker. We were under contract for an office complex that was listed at 4.9. We got it under contract at 4.2. And we did probably 20 to 30 hours of due diligence. There's 56 leases. We underwrote everything. I mean, we, again, spent more time on this property than we have on any other property in history and meticulously underwrote it. Did a roof inspection, did everything. And we went back to the broker and we showed him our underwriting. And we're like, buddy, this works at 3.5, not at 4.2. And here's our numbers. But I also said, look, tell us if there's something we're missing. Help us help us get this deal done. We want to get it done. And this guy's take was, I can't believe you guys did this. Well, first of all, an older asset with a fair amount of vacancy, a fair amount of accounts receivable, newer tenants, of course we're going to dive into this. But, he takes the stance, well, we had another group that was a 1031 buyer and they were just going to do 30-day close, minimal due diligence. But we went with you guys, even though you had a lower offer because we believed in you. Bullshit. You didn't believe, come on, man, cry me a river, right? Why wouldn't you go with a 1031 buyer for higher money?
You're right. They should have, he obviously is making that part up. They didn't skip over on a 1031 buyer for your lower offer. But were there things you found out that you should have known already?
No.
Like the age of the roof, for example, should you have already known that needed to be repaired?
We had an idea. The roof was not the major concern. There's a few roofs that need to be replaced. It was their accounts receivable was a big one. We didn't have access to that, right? But some of their bigger tenants are not paying. And you and I know this. When a commercial tenant slow pays or stops paying, the writing's on the wall. Yeah. I don't think I've ever seen a commercial tenant recover from not being able to pay their rent.
Yeah,
now, if they're upfront about it and hey, man, I got this going on, blah, 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 I'll hit you up. Great. But if you're making the call and hey, where's my rent? And they don't recover. I've never seen that, right? And I shared that with the broker. I said, look, man, some of your bigger tenants are slow paying. Some of them are 90 days behind. You and I both know they don't recover in this world. He's like, yeah, you're right. So, but the guy went on to be like, you guys embarrass me. I'm not going to be able to get this much money off. I can't believe you did this. You would have thought I slapped his kid or something. So, first thing in the morning, less than, 12 hours later, we get an email. Hey, I got you $400,000 off.
Hey.
But the deal doesn't work. Now, here's why it works for us. We're willing to buy this at a 2-3% cash on cash because there's 16 buildings and we're going to sell them off individually. So it works for us, right?
So you're going forward?
No. If he comes down to 3.5, we will. He got $400,000 off, so he went from 4.2 to 3.8. If he can get 400 off just like that, he can pull the other 300.
Do it,
So
Ash. Good for you.
yeah, and screw this guy for his attitude. Like, just be transparent, get the deal done. Stop playing the used car salesman game. Oh, there's nothing I can do.
I
We already
know,
came
broker
down
game.
700,000. We have no room, and all of a sudden you have room. Like, now you're good, right? So, all right,
That's
man.
how you get the good ones, Ash.
Yeah. What do you say we get started with this podcast?
Let's do it. Let's bring him
All
in.
right.
Brad Johnson, welcome to the best ever CRE show. How are you doing today?
I'm doing great. Thanks, Amanda.
Hey, we're happy to have you. Excited about this conversation. And before we get too far along, can you give the best ever listeners a bit about your background and what you focus on now?
Yeah, so I come from a real estate institutional background, worked on both the buy side in private equity and for a real estate investment bank. And in 2013, branched off and started a company that focused on buying mobile home parks, manufactured housing communities, bought a portfolio of about 2,300 pads and sold that portfolio in 2020, right around COVID, which was a fun experience. And then have been, now that the pricing makes more sense, have been leaning into buying more parks and building up our portfolio using other operators through joint ventures so we can expand nationwide.
That's super interesting. And okay, whoever's not watching this, Brad looks like he comes from a private equity background. He looks so nice and put together. And then you have me and Ash. Okay, so well done, Brad.
But he also invests in mobile home parks.
What's that? You do invest in mobile home parks?
No. I said I'm discrediting you a little bit by saying you're investing in mobile home parks.
Yeah. It's an interesting space. It has a bit of a stigma, but there's certainly a misunderstanding. There's the trailer park that you wouldn't want to drive through at night. That's not what we're doing, right? We're talking about nice communities. A lot of them look like subdivisions where you would be fine, putting grandma in a double wide in a nice community with amenities. But there is a spectrum for sure.
Brad, in 2013, when you started investing in mobile home parks, you were with a company. What was your role?
So I was more the acquisition finance guy, the engine of growth. And I partnered with somebody that had owned a few parks and was really good at the boot on the ground operational side of the business. Now, one little quirk about this space is there's not really third-party property management in any meaningful way. So you have to actually build out the team. And so I ended up getting way more involved in operations than I might have otherwise at the start. But we built a team of 30 people who were really running the day-to-day. And you have to do that in this space. You can't just say, hey, come hire, this property management company and take over all of our parks. There's no real national firms that do that.
In 2013, when you started, mobile home parks were not a very sought after asset. They've been on fire recently. How are you getting acquisitions today?
Yeah, so I talked about we really like to partner with groups because there's only about 40,000 of these parks nationwide, and there's probably only 10,000 of those that you would actually want to invest in and own. And so they don't trade that often. So you need to leverage people in local markets, I've found, to really find the best deals. For example, the last 4 deals that we've invested in, those never even crossed my desk. And I am pretty networked in the space with all the brokers and players that are operating in this niche. But if we didn't work with these partners, I never would have saw them because all 4 of them were off market. They were, our partners had been reaching out to the owners, mom and pop ownership type groups, or for years, right? And so finally, the timing made sense for some of those to sell, and we happened to be there to help these deals get closed, be a big chunk of the capital.
Brad, what are you buying? Okay, so you said there are only about 10,000 that you actually would be interested in owning. They look like neighborhoods. Are you buying retirement communities in Florida? What are you guys buying?
Yeah, it's more in the middle. So I would call it more working class, affordable housing. We have a couple of parks that I would consider a 4-star. So think about it's a 5-star scale. 1 is a trailer park. 5 is that community you just talked about in Florida with the bocce ball, the paddle ball, pickleball, right on the water. We're not doing those. Those are very expensive. Those are like 9% type of returns for investments. We're doing more what I would call a 3-star park. And maybe you get those to a 4 where you're adding some amenities and it looks more like a subdivision. But that's our bread and butter. Is there a 3-star park that, really is going to be, a 15% type of IRR. The ones that are in softer markets with more value add opportunities are more like 18, 20. And then the ones that are in really big markets, 100% occupied, pretty close to a downtown market, are more like 13 IRR. So it kind of averages to that 15 is my North Star.
And do you have partners across the US? Will you buy anywhere, or do you have certain geographies where you like these communities?
Yeah, the nice thing is that when I was buying in 2013 through 18, we could go to more markets because the pricing was cheaper. Now I won't go to a market that's pretty small and remote with not a lot of job growth. So I've narrowed the markets that we will actually go to because when you could buy something at a 10 cap, a lot of things could go wrong. Occupancy could drop down, and you're still going to get a great IRR. Now you got to be more thoughtful about where you're going. Now we're not talking, we're not going to major 24-hour cities. That ship has sailed, right? You're not buying a mobile home park in New York. You're not buying one in LA, right? Those never trade, and they're quite expensive. It's more like we have a big portfolio that we're about to start working on in Raleigh, just outside of Raleigh. So, it's not in the downtown center, but that's a great market for us. Columbia, South Carolina is a great market. So it's kind of like in the Southeast is where we're primarily focused, but we will opportunistically look at deals in the Mountain West, right? We just did a deal in Montana a couple months ago. We did a deal in Washington outside of Spokane. And so, yeah, we like to pick our spots. We tend to avoid the coast. We're not going to go to the Northeast, and we're not going to go. We're not going to be buying California. And Florida is a great mobile home park market, but I am very scared of hurricane risk, so we tend to avoid Florida as well. So that's generally what we do.
Hey, you're in my backyard. So we're in Raleigh. We're actually selling a park in Columbia right now.
Oh, wow.
It's not off market though, unfortunately. But how do you do due diligence across all of that? Right? There are so many things that change with mobile home parks between North Carolina, even within North Carolina. Like there are out-of-state investors coming in here buying stuff that is appalling for prices that is scary. How do you do the due diligence across the whole US?
Yeah, so that's where our partners come in. Really, I figured out that we wanted to have regional operators that have boots on the ground in that particular market that know the weird quirks from a regulatory standpoint, right? Some markets, they have setback rules, right? If you bring in a new home, it's got to be with certain parameters. And you're right, you can't know that in 50 different markets. So we really like to partner with groups, and we bring our capital expertise network, and they are taking care of the property management. So that's generally how we solve that problem. Part of it's just time in the space. You kind of get a sense for most of the due diligence issues. I mean, really, the nice thing is because we don't have to worry about new supply in this space, most of the due diligence items are pretty vanilla in terms of just, what's the infrastructure like? Do they have a permit? It's kind of checking the box versus it's very difficult in most other real estate asset classes to do due diligence on demand because you don't know, is there another product type, another building that's going to compete with us coming in across the street in the next 3 years? What are the jobs looking like in this market? As long as population's stable and there's a decent amount of employment base, we're going to be fine in this space. We're the lowest option from a housing standpoint. So a ton of demand.
Yeah, as long as the population is growing and there are jobs.
You don't want to, declining is no good.
Okay. It's no good. So most of your due diligence then is on the operators. Does that sound right?
First it's the market, right? So that's the first screen. And then the operators, we've been partnering with really our core is about 7 groups that I've known for quite some time. We started out with 15. A lot of those, 8 of those did great, but they're not elite. So we've kind of narrowed it into the groups that we want to continue to work with for the next 20, 30 years. And so, yeah, that is a big part of it, is making sure that they know what they're doing, because most people will get a package for a mobile home park deal, and it's very difficult for them to get a sense of, does that operator have the expertise? Do they have the team in place? Do they have the operational alpha to be able to pull this off? Because it's not, the thesis for this space is amazing, right? It's like, growing demand, decreasing supply, fantastic thesis. But they're very challenging to run. Like, most people think, oh, it's mailbox money. I own just the land, the tenants own the home, and there's not going to be any problems. Great. No, that's not how this industry works. It's very operationally intensive.
Brad, what are the pros and cons of working with Vintage Capital? If I have a deal, show me the benefits and the drawbacks.
Yeah, well, right now it's particularly useful because people are having a hard time raising capital on debt. And because of that, they're having to do 50% equity slugs. And so we will come in and we solve a lot of that problem for them. We tend to not want to take the whole deal down. We tend to want to take a big chunk of the deal to help them cross the finish line. And then they can bring their own friends and family, their own personal capital. And then it's networking with other operators in the space, best practices, bringing them new deals that come across our desk in these markets. But really what we're solving right now for people is that, the financing in this space is challenging when you're buying from mom and pop that haven't raised the lot rents to market in 20 years. So then all of a sudden your debt service coverage ratio on a new loan is artificially low, right? So raising 50% equity is challenging for a lot of groups, especially when people are skittish because the stock market volatility has been spiking. And so that's mainly our big value add, is bringing capital and solving that problem for them. And most groups don't want to go with private equity in this space because of the dynamic we talked about, where there's only 10,000 of these things that you want to own, and private equity wants to get out in 3 years, maybe 5, right? That's their ideal time period. And when you take years, right, reaching out to a mom and pop owner to try to tie one of these parks up, you do your value add plan. Yeah, you get a great IRR, but the equity multiple is not unreal, right, in a couple of years. So then you are having to sell it when you wanted to hold that asset for maybe 20, 30 years, right? Because they're not making any more of these things. So that's another thing that we're offering, is that we don't have an artificial, like, we got to get out in 3 years. We got to get our money back so we can recycle it. We are very tax driven, after tax return driven for our investors. Because private equity firms, as you think about it, their investors are endowments, pension funds. They don't care about tax. They're not taxable. So they just are IRR focused, but you can't eat IRR, right? So we're equity multiple focused on an after-tax basis, get our capital out through a refinance in 3 to 5 years, and just collect the cash flow from then on. And very few firms are set up to do that.
Is there a minimum deal size?
Yeah, I mean, 50 pads is kind of the minimum. I generally like to see 100 pads. That's really the sweet spot from an operation standpoint, because you can hire better staff on site when you have at least 100 pads at 500 plus market rent, sometimes 400.
What are the drawbacks of working with you?
Well, less promote, less equity for the sponsor. We typically, we will either take just an asset management fee on our capital, or occasionally we will take a sliver of the promote. Sometimes it's 5%. Sometimes we pass that through to our limited partners, right? Because it's some of my capital, and then it's a lot of our limited partner capital that close these deals. So yeah, some investors want to keep the whole deal themselves, right? We obviously are going to be an LP in your deal.
Would you come in as strictly an LP, or do you also want GP shares?
We do it all, right? So we've done plenty of minority GP deals where we've put the whole package together. We brought the private equity group. So we've stood up a couple 20 million mobile home park platforms where they bought a portfolio. Private equity is the main LP, and we're a sliver of it. And then but most of our deals, we're straight LPs, right? And we're bringing a bigger check. So maybe we get a discount on the promote that we end up passing through the majority to our investors. So yeah, we're not set up to where we need to get GP economics, but it kind of depends on the size of the deal. How much am I involved? Whether or not we're going to end up taking any GP.
Good. So every deal, you just get creative. You try to make it a win-win, and you're not predatory because you've got all the money.
Yeah, no.
Good.
It's my view on this space is, it's a 30-year type of investment, right? So you're trying to compound relationships in addition to compounding capital here, because there's some operators that I've invested with on 7+ deals now, and it gets faster and faster and faster. The flywheel, the efficiency of doing deals with partners that you trust and you have a working relationship with is incredibly powerful, because I don't have to go in the weeds on every deal. I trust them implicitly that they're doing the right thing with our capital and that they know how to run parks. So yeah,
Brad,
we're playing long games.
What if Amanda brings you a deal and she's got some of her own money and some of her own investors in the deal, but she wants a 3 to 5 year exit? Does that not work for you?
No, it does. It's just a different subset of capital for us. The majority of our investors, our LPs that come along with me, like the one-off deals where we're going to take bonus depreciation up front, right, which is huge in the mobile home park space. Like, it's usually 1-to-1 on your investment. Dollar goes in, you're getting 100% of losses on that invested capital year one, assuming the new tax bill does pass. I think it was released yesterday. The 100% bonus depreciation was in there. So you all of a sudden you have a negative, or you have a big depreciation, loss that you get to shield capital gains taxes. So you don't want to sell that usually in 2-3 years, because then you got to do depreciation recapture. But if it is that type of deal profile where it's more of a fix and flip, we have a subset of capital that is in a fund structure that is more IRR driven, that is more 7-year type of money, that we will sprinkle in those value add deals that hopefully are 20% IRRs to then boost some of the more core deals that we have where, maybe 13 to 15 IRRs. So we can get that average portfolio IRR up.
And Brad, do you care? So like, on a lot of your deals, right, you are getting a management fee. So then from your perspective, what are you thinking when you're deciding, hey, should we go for more value add deals that are higher risk, but potentially higher returns for the money that you're managing, or more of these coupon clippers that are safer? How do you navigate that mix when, your asset management fee doesn't necessarily change either way?
Yeah, so we definitely have a bias towards long-term holds, right? So out of the 6 deals we've done in the last 4 months, 4 of them, I hope they never sell, right? I hope I'm giving those to my kids, those investments, at a stepped up basis, right? The other 2 are more IRR driven, where we might sell those in 5 years. Now, once again, that is increasing the kind of portfolio IRR, and it adds another type of investor to our business that is more, they want to turn these investments faster. So my bias is certainly for longer, but I love a good value add deal too, where you get to come in and really change the appearance of a park. And from my viewpoint, that type of investor is going to do more deals. So we're going to make up for it on the volume of deals that we do with that investor, versus because we are going to be churning deals a little bit more with them. And then we have our nice stable base of, call it evergreen properties, that we're going to hold it indefinitely.
Brad, you said something interesting, that pricing right now makes sense for mobile home parks. I don't think I've heard any investor in the past 2 years say pricing makes sense on anything.
Yeah.
Can you dive a little bit more into that?
Yeah, it's always counterintuitive in real estate. When the cranes are everywhere, construction, new development is happening, and it's go, 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 that's generally a very challenging time to put money to work. When it's tough to finance deals, it's tough to make deals work, that's when you want to be pushing capital in. So it's countercyclical. But with mobile home parks, they've been incredibly steady. If you look at the public REITs in the space, they never had a negative year of NOI growth. It's up and to the right for NOI every single year, just regardless of recessions. And now we have this dynamic where you're buying from mom and pop who have owned it for 30 years. Maybe their father developed it. Or you're buying from their kids that have inherited it and are like, what's this mobile home park? I don't know what to do. So they are selling it. They have not been keeping up with market from a rental standpoint. or they haven't reinvested into the park. They've just been taking the cash flow, and now it needs professional operations. It needs new capital. And that justifies you to kind of gradually increase the lot rent over time. I am 100% not an advocate of just doubling the rents because you can. Like, I am very much about let's make this a sustainable investment. Let's grow the lot rents to market over time. If you keep them artificially low, you're not going to be able to reinvest back into the space and make these functioning properties. But that is one dynamic why they still make sense from a return standpoint, is because the lot rents are way below market versus what stick-built homes are, right? So if you're going to a market where the median stick-built home is 300,000, 400, 500,000, there's going to be insane level demand for that mobile home park. And you just need to kind of get the rents to market over time. Maybe you bring in some park-owned homes to help fill occupancy, fill vacancy if there's any vacant pads. But there's more things you can do with that type of property than you can in a fully occupied industrial building, a fully occupied brand new apartment in the Southeast. I found it's not a cap rate compression game. It's what can we do from an operational standpoint to increase NOI.
Yeah, I think you're onto something there. With it has to do with the number of assets, right? Because they're not declining and they're getting more and more in demand every year. And there are still plenty of parks where the lot rents are well below market rate. So that does make sense. The pricing, I find, is still incredibly challenging. Trying to make work right now. A lot of sellers have these brokers in their ears every day now, because I'm not just calling them, so are the brokers telling them what their parks can be worth. So I've found it's gotten a lot harder to get mobile home parks for the price that does make sense to be able to make the investment. But you're saying, hey, even though that may be harder, use just like the long-term trajectory of the asset class, and therefore think it's the right time, just because basically the number of them isn't growing.
Yeah. And I think more about it on a cap rate basis. You're absolutely right. Like the cap rates make zero sense, right? Because these sellers, they haven't been keeping up with lot rents. They haven't been reinvesting in the parks, but they still hear about these prices that for transactions. So they're like, I want something closer to that, but their NOI doesn't justify, can't get a loan, right? So most of the deals that we're doing right now are off market, direct to the owner, where he is carrying a note, like he's doing seller financing, right? And so we are oftentimes overpaying on a per lot basis relative to his NOI, but he's giving us artificially attractive seller financing, 4 or 5%, 10-year locked up interest only type of debt.
Tell me more about that, right? Because a lot of people that tend to work. We actually just bought a seller finance park last month because that is working right now, that we probably couldn't have gotten a LODA, right? The lot rents were too low. But how does the cash flow to your investors then look if you're, quote unquote, like overpaying in year one? Do you have a delay in when the seller financing kicks in, or are you kind of just not really returning in the first year? How does that tend to work out?
Yeah, sorry. And when I say overpaying, I mean relative what a lender would value it or an appraiser would value it, which means nothing. It's what I care about is year 3 yield, to an extent year 1, 2, is make sure we can generate cash flow. But I care about year 3. And we're seeing deals you can get to a 7 by year 3. And I don't think you can say that with confidence in a lot of other spaces. And so really, especially if there's some hair on it, right? If we're bringing in, more homes to fill vacant pads, like we feel like we can move the needle and get it closer to a 7 in year 2, right? So I just found that there's more dials to turn in this space. Nothing is, quote, cheap. You're not finding steals, right? When I was buying in 13, 14, I was buying 20,000 a pad, right? So now we're buying 40 to 100 a pad, depending on, the attractiveness of the market. But it's more about my confidence in where the NOI is going to be within 2 to 3 years. That is, quote, overpaying, but we still hit our returns. Is kind of how I think about it. But we're not backing up the truck and doing 30 deals a year too, right? It is still having to pick our spots where we can find these deals off market with seller financing where the math still works.
Brad, when you say in year 3 you're at a 7, is that a 7% cash on cash?
So that's a 7 NOI yield. So that's like unlevered.
Got it.
And then if you have accretive debt, right? So if you have 4% debt because it's seller financing, that IRR gets really powerful. And then what I'm finding is that a lot of these deals are set up beautifully for a Fannie Mae takeout by year 5, right? So, and some of them we actually stepped into and have assumed Fannie Mae loan with a supplemental already kind of teed up. So assuming we can get that NOI to where we think we can by year 3 to 5, then all of a sudden we are taking out all the LP capital or dramatically reducing the LP capital, which gooses the IRRs.
You said 5 to 10 year interest only loans. Is that prevalent in this market?
5 years, 10 is rare. But
Okay.
yeah, I mean, I see plenty of 5. Sometimes it's 3. But yeah, sellers, my first deal I ever did was a seller financed loan. And I was shocked, right? Because I'm coming from the institutional world. And I was like, why would you ever want to do this? But these owners, because they've owned them forever, they know how reliable the income is. They're very comfortable carrying a note, especially if it's a 50% note, because they also don't want to pay the taxes right away. They want to draw that out, and a note helps them do that. And frankly, a lot of them wouldn't even know what to do with the money anyway. Some of these guys have been managing the property for 30 years. They still want to stay on and help out after the sale. It's the craziest thing. I've had owners, continue to do the mowing, help out with collections. It's just kind of a lifestyle for some of them.
Brad, you've been in the space for a long time, and now you're putting a lot of faith in these operators. I'm sure you've got some battle scars from that. What are some of the, oh my God moments that occurred when you have an operator other than you managing these properties?
Yeah, thankfully, we have avoided drama for the most part, like catastrophic drama. We've had the operator who missed filing a permit with the city, and then all of a sudden we're like, oh, we're an unlicensed mobile home park now. That's not good, right? And so you're kind of scrambling, helping them out with that. We've had very late tax returns, which is kind of a nature of the beast when you operate this way. And so we always just extend. But yeah, we've really avoided the catastrophic drama, which a lot of people got into trouble, mostly I think as a function of not only just overpaying at peak cycle, but putting on, floating rate debt. And that just wasn't as prevalent in our space. And frankly, I always thought I was too conservative because I never did floating rate debt. Buying in 13, right? I left a ton of money on the table for those 7 years, only doing fixed rate debt because I wanted to sleep at night. And so when we work with operators, we're also in that camp of like, to fix it, term it out as long as possible, because where people get hurt in this space is they don't have a real team. They're trying to do it from 2,000 miles away. And, or they put on, too much floating rate debt with not enough term. They do a 3-year loan. Who the hell knows where your operations are going to be in 3 years? It's much easier to predict 5 to 10 years in this space where where your total NOI and lot rents are going to be. So yeah, I mean, we avoided most of the drama. And part of that was just because I made so many mistakes when I was starting off as an operator, trying to do this, from too far away. But I had more of a margin of error in pricing. So now I can kind of sense those groups that don't have a real team or real systems in place pretty quickly on a call.
Over a decade in this space, why have you not looked at other asset classes?
I mean, I've dabbled in other stuff. Like I have a storage building, it's a great sector. I love it because it has similar characteristics about not having to every year spend on giant capital improvements, right? Like mobile home parks, you spend capital quickly, like within that first year, but you don't have to keep spending more and more capital, right? Which is it's kind of the sign of a good business if it's capital light, right?
All right,
so self-storage is similar.
I was really feeling you. You seem like a smart guy. You like mobile home parks, but now we're talking about storage. That's like our least favorite asset class. All right. What else besides storage do you like?
Yeah. I mean, don't get me wrong. I haven't made good money in storage. So I do like the idea.
Nobody is right now.
Nobody.
So I've dabbled in it. I'm by no means an expert in storage. I don't know. I've found that you tend to do better when you focus on things. So I do other investments that are non-real estate related, like private equity, and I do a lot of real estate debt. But I think of that as a different asset class, right? So I love real estate debt investments. I love owning parts of private equity firms' general partnerships. Like I do that in a meaningful way. That's probably my second largest investment outside of mobile home parks. But I don't do a lot of other real estate deals because, if you focus on one thing, it just compounds things, knowledge, relationships, deal flow. It all compounds faster than trying to, be good at a lot of things.
Brad, are you funding flippers or rescue capital, or what kind of debt are you raising?
So yeah, we actually mostly just do investing in funds, debt funds, right? So we don't do a lot of like, here we're writing $1 million check for this one deal. We invest into a bunch of funds with experts in real estate debt.
What kind of funds do you like right now? What is working well?
I like pref, mezz, right? I mean, pref is technically not debt, but it feels a lot like it when the loan to LTV is 50% on the first mortgage. So I love, when you can get equity returns for debt risk, I mean, especially after we've had a correction, like now is a very good time to be a lender. So that is compelling, right? You're kind of, in that double digit range, sometimes even 15% if you're doing pref. We actually just put out a term sheet for our first pref deal in the mobile home park space because of this dynamic that we're talking about where, you don't have enough debt. So we're trying to help groups, solve their capital problems in multiple ways moving forward, not just equity.
Brad, on some of those, so let's say mobile home parks, right? You have your 7-8 operators you've been multiple cycles with, you trust them. On the debt side, some of these debt funds are pretty new. A lot of them have come up in the past few years.
Yeah.
How do you look at due diligence on the operators and the funds on the debt side?
Yeah. So one of the advantages of if you're a former operator in the space and you have a large group of operators that you work with on a daily basis, then if that deal does go sideways, you feel better about being able to step into the deal. So nothing changes from an underwriting standpoint, right? We underwrite the operator, we underwrite the mobile home park. But now, I'm looking at it, okay, I can go with a newer operator I don't have a relationship with, and maybe they're a little bit outside on the risk spectrum versus in terms of their total portfolio, in terms of their total team, because I'm investing in a debt type of capacity, which is lower risk than common equity.
I actually had that wrong. So I was assuming, you said you had the one, pref equity or rescue capital for a mobile home park. There's just not that much in mobile home park space that's in distress. So are you actually coming in, is your debt fund also all mobile home parks, or is that with more of a diversified? Oh, interesting.
Yeah. So there's two things there. So me personally, and with some of our clients, I invest in debt funds. We, Vintage Capital, are starting to look at doing debt in this space as well, just for mobile home parks. And the compelling part about that for the operator is that some of these guys, have a track record of doing 30 to 40 IRRs on very smaller deals that are hairier, right? That are 3-year, the type of holds that we talked about, that are big turnaround deals. And they love the idea of 15, 16%, pref that they can get rid of in 3 years. It's not a big multiple, but the returns are pretty compelling for that type of investor that just wants to feel better about their risk in a deal and still get an equity-like return.
Are you not bailing out any of the multifamily guys?
No. I used to know that space when I was on the institutional side, but I've been out 10 plus years, so I wouldn't know what I was doing.
Good for you for using restraint there and staying in the asset class,
Because a lot of them have botched that whole industry up pretty good.
Yeah. There is, you read the headlines and it looks tough. And especially when the pref investment really is almost just like a capital call. It's not even really a new investment. I try to stay away from that stuff. We like to focus on new deals, or even a fund. I think a fund is interesting. If the GP really, at the end of the day, these guys and girls are trying to get more and more equity so they can hold these things long term. And so that's a compelling way for them to not have as many limited partners, or maybe buy out some limited partners, and then they can get more of the GP for the long term.
Brad, how can the best ever listeners reach out to you?
Yeah, so you can go to vintage-funds.com. Shoot us an email, info@vintage-funds.com. Yeah, we're active. We're doing a big deal in Raleigh here coming up and have a big pipeline of parks. So happy to chat with people, teach them more about the space. We're an open book.
What are typical returns for your investors?
So our track record is great. We've done gross low 20s on average across all of our deals. The moving forward, like I said, if it's in the bucket of forever hold, you can't get a 2020 or 22 IRR for 30 years, right? So the returns do come down over time, but the ones where the majority we've been able to either have a sale or refinance fairly quickly. So those IRRs are pretty high in this space. But once again, if it's a 30-year hold, then we're looking more in the low to mid teens. But I've found as long as you can kind of shoot for a 15, some are going to be better, some are going to be worse. You're going to turn out very well compared to most other investments in the space.
Brad, thanks for joining us today and talking mobile home parks. Best ever listeners, thank you for joining in today. If you enjoyed this episode, make sure you leave us a 5-star review and share it with somebody who could find it useful. Please follow, subscribe, and of course, have a best ever day.